How do we think about core Europe versus some of the more distressed markets like Spain and Italy? It seems to us that the broad consensus today is that Germany is the best opportunity, with France and the UK not that far behind. I think there may be more challenges to investing in all three of those markets than current average sentiment recognizes. First of all, it's a great thing that the issues around the Eurozone staying together for the moment have receded. At the same time, I'm not sure that there's really been any solution to the principal problem, which is what's going to drive growth going forward. Equally, I'm not as comfortable that simply printing an enormous amount of currency as a way of solving the debt problem, while it's eased the market, that it actually has done anything to address the fundamental problems. If anything, in some way, it probably exacerbated them, because now there's more and more debt than there ever has been that has to ultimately be repaid. So in an environment where we actually have, for the moment, an intact Eurozone, but an extraordinary and growing amount of debt, a lack of real consensus on how Europe is going to evolve to the political union that's probably necessary to finally confront the structural problems that it faces, should we feel comfortable that we've kind of reached a bottom in Germany, France, and the UK, and that ultimately investment there will be rewarded in the near to medium term by a return to growth, because fundamentally, of course, growth is the single biggest driver of real estate opportunity. I'm not so sure. On the one hand, real estate obviously offers an inflation hedge, and even a debt product focused on European markets with floating rates offers a proxy for an inflation hedge, and therefore there's something to be said for being invested in hard assets where there's at least the possibility of meaningful near-term inflation. At the same time, clearly Germany has paid the largest price and will continue to pay the largest price for whatever is done in Europe to ultimately restructure the European market, and the German taxpayer will, for better or for worse, bear the largest share of this burden. Is that going to ultimately have a positive or negative effect on growth? I think the jury's out, but I think you have to be cautious when you approach Germany about whether or not it can continue to sustain the growth that it's had and will deliver above average growth in the next cycle. We're particularly concerned about France, where we think the change in government and change in policy is not pro-growth and is actually potentially exacerbating some of the structural problems that the French economy faced. We think that that can be near-term negative for real estate. In particular, there seems to be a lot of concern about changes to the tax system, and fiscal uncertainty is always bad for real estate investing. Fundamentally, real estate investors prefer growth environments and prefer an environment where they can see what's coming with some level of certainty. So overall, I'm a little concerned about the near term, certainly in Germany and France. In the UK, clearly a lot of pain has been taken in the UK to try and restructure, and whether or not that's going to bear fruit and how long, I don't know. Whether the current uncertainty around the euro and Britain remaining in the Eurozone is going to have a chilling effect on what would otherwise perhaps have been a more successful restructuring also remains to be seen. The opportunities in real estate in the UK, I think, are going to be London focused, which remains a very competitive market. Less so in secondary cities in the UK like Manchester, Birmingham, and Liverpool. Our strategy overall in the UK is to focus on income and lending and recognize that it's a very competitive market with a lot of capital here searching for opportunity.